Hello, and thank you for joining us in part 2 of estate planning. In this webinar series, we're going to be discussing advanced estate planning. So we've already gone over the basics of estate planning. Now we're going to take a deep dive into the advanced aspects of estate planning. My name is Martin A. Smith. I am the president of Wealth Care Financial Group. We are a wealth management, retirement planning, and investment advisory firm. We're located in Peachtree City, Georgia, as well as Washington, D.C., and Maryland. Wealth Care Financial Group is a state-registered investment advisor. I'm your host, and let's get started. Advanced estate planning, an overview of some sophisticated estate planning strategies. Here we go. So, who needs advanced estate planning? Well, if you have a net worth over $11,580,000, which is the federal gift and estate tax basic exclusion amount in 2020, you need advanced estate planning. Now notice that over the last 10, 15 years, this number has increased dramatically. So this kind of leads, as I stated in the previous webinar, this leads into one of the reasons why the tax cut was so popular for business owners and the wealthy. They've increased the exclusion amount, and it is now $11,580,000. So if you have a net worth over that amount, you definitely need advanced estate planning. You want to provide for your grandchildren or later generations. So this is generational planning. One of the magazines that I read is Worth, and I believe their inaugural issue, it was entitled The 100-Year Plan, and it talked about generational estate planning, like the Carnegies, the Mellons, the Rothschilds, etc. These are families, the Kennedys, that have had estates that are enormous, and they've planned for many generations. And so this is what we're talking about and the importance of it. If you own a family business or a farm, you need advanced estate planning. If you want to donate to charity, even at a basic level, you still need some degree of advanced estate planning. And finally, you want to shield your assets from future creditors, an ex-spouse, or your heirs, creditors or ex-spouses. Yes, unfortunately, the wealthy tend to get divorced a little bit more. We've seen it. You know, our president has had how many marriages, right? So they have a need for advanced estate planning. There's a balancing act. Advanced estate planning strategies generally comes with trade-offs. One is there are implementation costs, and you have to be willing to relinquish certain financial benefits of your overall net worth and estate. There is some loss of control, and so again, for example, now we're talking, this isn't revealed yet, but we're talking primarily about gifting strategies and charitable strategies. And when you're thinking about being altruistic and doing some philanthropy, then yes, there's some loss of control. There's some relinquishing of financial benefits directly to you, but there's also some tax benefits that you could receive in turn. Let's discuss the federal transfer tax system. So during your lifetime, here's you, and you make transfers subsequent to gift taxes to your donees. At death, here's your estate. Transfers may be subject to estate taxes, your beneficiaries, and so you have generational skipping transfer tax may also apply in this regard. So you have gift tax for lifetime gifts that are made. There's estate tax. There's property that could be taxed when it transfers at death. And as I mentioned, generation skipping transfer tax transfers to individuals more than one generation below you. And there are some reasons why that may be advantageous for you. So the unified system of the federal transfer tax system, here are taxable gifts, and of course you date the value of the gift plus your taxable estate, and that equals the cumulative taxable transfer. So gifts and estates taxes are unified, and gifts may be made during life and are added to transfers made at death on estate tax return. Generally, gifts are valued, and they're valued as of the dates they were made. Transfers made at the death are valued at the date of death. And these are important things that you want to be aware of. And when we do advanced estate planning, we definitely are working with your attorney, with your financial advisor, and your tax advisor, as well as a team doing this wealth management service for you. Any estate tax owed is reduced by gift tax paid. And then generation skipping transfer tax is separate. So looking at the federal transfer system, top tax rates of 2018, 19, and 2020, 40% across the board. Generation skipping transfer tax, 40% across the board. And as I stated and showed in the previous webinar, for the past 2 years, the gift tax and estate tax has been 11.1, 11.4, and 11.5 or $11,580,000. So in this example, we have the estate tax exclusion or portability from one spouse to the next. So prior to 2011, estate tax exclusions was sort of a use it or lose it situation. In 2011 and later, exclusions are portable between spouses, which is excellent. Surviving spouses can use any exclusion left unused by the decedent spouse and may effectively double exclusion of surviving spouse. So in this example, $11,580,000 exclusion, no longer use it or lose it, of the first spouse plus the first spouse to die, plus $11,580,000 exclusion of surviving spouse, and the total exclusion to beneficiaries tax-free is $23,160,000. That alone is just the impetus for why you need to consider advanced estate planning if you have an estate that exceeds $11,580,000. So again, the generation skipping tax, transfer tax exemption amounts 2018, 19, and 20, 11.1, 11.4, and $11,580,000. Generation skipping transfer tax exemptions are not portable. That is not portable, at least not yet. The federal transfer tax system exclusion. So $15,000 gift each year to as many individuals as you want. $30,000 if you and your spouse make the gift together. So if you are a wealthy grandfather or great-grandfather with a boatload of grandchildren and great-grandchildren, you can just give out $15,000 to all of them. Or your spouse and you $30,000 total to each of them. $75,000 to $150,000 with a spouse to a 5 to 9 plan, and that gift is reported over 5 years. And payments made directly to an educational institution or for another individual tuition. And last, amounts paid directly to a medical care provider for another individual's medical care. These are all exclusions. Marital and charitable deductions. Transfers to U.S. citizen spouses during your lifetime or at death, fully deductible. Transfers to non-U.S. citizen spouses may qualify for $157,000 annual exclusion in the year 2020. And transfers to qualifying charities are fully deductible and may be deductible for income tax purposes as well. It's good to know. Minimizing estate taxes. So we're going to get into some of the more complex, unique nuance of trusts and ways to minimize estate taxes. So you equalizing each spouse's estate and optimizing the marital deduction. There's Q-tip trusts, there's bypass or credit shelter trusts, Dynasty trusts, GRATs, and QPRTs, and we're going to go into these in detail. So let's talk about equalizing each other's estate. John and Mary. John has $10 million. Assume spouses have unequal estates. Spouse with larger taxable estate can transfer assets to spouse with smaller taxable estate. And transfers are not subject to transfer tax because of the marital deduction. So as you see here, John 10 million minus 5 million can give to Mary, and now they both have $5 million, and the transfer is not subject to transfer tax because of the marital deduction. And basic exclusions apply for both of them, and there's no estate tax in that transfer. Now, minimizing estate taxes, optimizing marital deductions, maximum amount passing tax-free under exclusion. Here's John's estate, and there's a residual estate to the spouse. So you have John and Mary's children and Mary. First spouse to die leaves amount equal to estate tax exclusion to children, no tax estate exclusion, and then balance of estate left to spouse, again, no tax marital deduction, and defers estate tax until surviving spouse's death. So in this regard, you're going to you're definitely going to optimize that estate has a chance to appreciate, and it defers the tax liability until surviving spouse's death. Now, what can you do further? And what might you also want to do in this example? Perhaps John should consider a second to die life insurance policy on Mary. Because what if John and Mary's children go into a career that is not a high income generating career, like, becoming a high school teacher or something of that nature, and they inherit this enormous estate, and there's estate tax liability. A second to die policy can provide the funds needed to cover estate tax when the surviving spouse pass for the benefit of the children. So again, minimizing estate taxes, a bypass credit shelter trust. And here's what that looks like. So John's estate, the residual estate goes to Mary, and the trust assets, of course, restricted access to trust. And it allows both spouses to fully utilize estate tax exclusions while giving the surviving spouse restricted access to more assets. And assets passing to bypass or credit shelter trust utilizes the first spouse's exclusion. And the trust generally provides spouse with restricted access to the assets. And the children, they receive the funds according to the terms of the trust. So this is one very popular and advanced way to provide for surviving spouse and children. Again, upon death of surviving spouse, remaining trust assets pass to beneficiaries according to the trust terms. Now, qualified terminable interest property trust, or Q-tip trust. We have John's estate, we have Mary, and we have the children. So the maximum amount passing tax-free under the exclusion goes to the children. The residual goes to the residual estate goes into the trust, and then assets passing to the qualified terminable interest property trust qualify for the marital deduction. And then the surviving spouse receives all of the income from the trust for life with with access to principal according to the trust terms. So again, looking at this, let's kind of go back and replay it. John's estate to the children, residual estate to the trust, assets passing to the Q-tip trust qualify for the marital deduction, and the surviving spouse receives all income from trust for life with access to principal according to the terms of the trust. And then remaining trust assets included in surviving spouse's taxable estate when the surviving spouse passes. So this is a way to provide income for life for the surviving spouse, with the remaining going to their spouses, and it's included in her estate when she passes. And that's the taxable estate, which will be taxed. So that's why in this example, which is not here, as I mentioned in the previous slide, a life insurance trust could be useful as well, or a life insurance policy to cover some of those tax liabilities because those assets are received tax-free by the beneficiary. At surviving spouse death, remaining assets pass to trust beneficiaries. See how that works? Income for life for the spouse passes away, and then the assets go back to the children. So another strategy for minimizing estate taxes is a dynasty trust. So let's assume the estate is valued at $10 million. And so $10 million to the children, and then Dynasty Trust receives $10 million. In 26 years, with growth, grandchildren $39 million, the trust $58 million, 26 more years, great-grandchildren $142 million, Dynasty Trust $337 million. So Dynasty Trust preserves wealth for multiple generations of descendants. The trust survives 21 years after the death of the last beneficiary alive when the trust was created. It could last for over 100 years. You talk about a dynasty. And trust assets remain sheltered from transfer taxes, but not income taxes, while in the trust. So this is how some of the wealthiest in the world have preserved wealth for multiple generations through these amazing dynasty trusts. Assume that a generation is 26 years. The estate tax exclusion and generation skipping transfer exemption are $5,790,000. The estate and the GST tax rates are 40%. The growth rate is 7%. Principal is not spent, and the state variables and income taxes are ignored. So this is a complex plan, but it's definitely a way to increase and preserve the estate value by not having to deal with the transfer taxes despite the income taxes. Let's talk about GRATs. Using the grantor retained annuity trust removes property from the estate while allowing you to retain interest in the property. So here's a diagram. You transfer the appreciating property to the trust. Here the GRAT receives a property. The trust pays you an income or an annuity for a term of years. So you give the assets to the trust, and then you receive back the income. And the transfers assets at the end of the term to the beneficiaries. So this is really, I think, a really neat retirement strategy for retirees that have an enormous or a large or sizable estate or appreciated assets, and they just need an income stream. They don't need to have the bulk of the assets. So they give it to the trust, they pull an income, and at the end of the term, the assets are then transferred to their loved ones, their beneficiaries. So annuity paid to you for a specified period of years, then property transfers, as you can see here, to the beneficiaries. Transfers subject to gift tax at a discounted value. And property is not included in the taxable estate as long as you outlive the term of years. So the grantor retained annuity, meaning the income trust, is a wonderful way to remove property from your taxable estate while allowing you to retain the income from that trust. QPRT is a qualified personal residence trust. It's a trust that is funded with a personal residence. You retain the right to continue living in the home for a specified number of years. As long as you outlive the specified term of years, the home is not included in your taxable estate, but you must pay market rent if you continue to live in the home. Now, let's talk about an estate freeze. An estate freeze occurs when it freezes the value of property for a person, removing it from his or her estate, and then it transfers the future growth to persons receiving the property. It allows the retention of some control or financial benefit, and common estate freeze strategies include family limited partnerships, private annuities, installment sales, and gift or sale leasebacks. Those are some common estate freezes. So let's look at the family limited partnership. FLP is a business entity that enables transfer of family business ownership to the next generation. So if I want to leave Wealth Care Financial Group to my children, we would do it through a family limited partnership. So me, my spouse and I, Walida, my wife, we formed the FLP, the Family Limited Partnership, and I become the general partner, retain as little as 1% interest. I actually retain more than that, but retain as little as 1% interest. And I transfer to the FLP a gift up to 99% of interest to family member limited partners. So typically older generation becomes general partners and younger generation becomes limited partners. So in this case, my wife and I would be the general partners. Our children would be the limited partners. And I would retain greater than 1% because they're not going to get the control of my business. Not just yet. Want to protect limited partners from future creditors of business, and interests gifted to limited partners are valued at discounts as high as 60%. So again, it protects the limited partners from future creditors, and the interest gifted to limited partners is valued at discounts as high as 60%. So it's pretty nice. And of course, now, unfortunately, in this, look, you have to work with tax professionals. I always tell clients and prospective clients, I ask them at least, do you have a CPA? Not just an accountant or someone who does your taxes. Work with a CPA as much as you can, at least. Try to. Because when you get into this type of advanced estate planning, you really need someone who is well-versed in the tax code and knows what they're doing and have years of experience. And most people who are doing estate planning at this level, they've had a CPA for years. But there's a high risk of IRS challenge, and you need an advocate on your behalf to help you in that regard. So an estate freeze or private annuity, here the sellers are your spouse and you, the buyers are the children. They receive the property, we sell to them, there's income for life to spouse and I. The property is sold in exchange for unsecured promise to pay specific income to you, myself, or to you and your spouse for life. The transaction is not subject to gift tax because it is a true transaction. There's a buy and a sell, and it removes the property from the estate entirely. Charitable giving. You should always start with your church, in my opinion. I've, been blessed to be a part of giving, and I enjoy seeing what happens with gifts that we give. I really enjoy seeing how lives are improved and changed and encouraged through gifts. So charitable giving is special. We love it, and I'm so happy that it's a big part of estate planning. So charitable giving can be rewarding on a personal level, and it is fully deductible for gift and estate tax purposes. It may also be deductible for income tax purposes, and planned giving options include simple bequests, outright gifts, charitable trusts, charitable annuities, community and private foundations, and donor-advised funds. So there are a number of vehicles that will encourage and assist you with being charitable. Charitable giving, let's talk about Charitable Remainder Trust, CRT. So you and your spouse, you gift your assets to the trust. It is irrevocable, and you receive payments for life. The trust then gives the assets to the charity at your death. So you gift, let's say we had $1 million portfolio, and I just need the income. I'm 78 years old, don't need the money, the $1 million that is. I just want the interest the $1 million generating. So I'm going to gift that to a Charitable Remainder Trust, and I receive the remainder portion. I receive the income. I receive the income, and then the gift remains in the trust, and it goes to the charity. So you give the gift, income payments for life, the asset through the trust is given to the charity at your death. That's how the CRT works, and you may be able to serve as a trustee to control assets. Now, that's important. I may want to control how those assets are managed to make certain that is, one, generating enough income during our lifetime, but also that is managed prudently so that the charity receives 100% or more of the gift if we can grow those assets. You don't want to just gift money to a trust and just be like, I'm done with it. No, there's still a fiduciary responsibility that someone has, and hopefully you're going to take that responsibility to make certain those assets are managed prudently so the charity receives that benefit. Let's talk about a charitable lead trust. A little bit different here. With a CLT, the charity receives payments during your life or the lives of you and your spouse for a term of years. You or your beneficiaries receive trust principal when the trust period ends. The value of transfer reduces by the value of payment stream to the charity and channels futures appreciation to the beneficiary's estate tax free. So here's what happens. You give the assets to the trust, the charity receives the payments, and then the assets goes back either to you and your spouse or to the beneficiaries when the trust period ends. So maybe I want to gift assets for the income purpose for 10 or 30 years. I've got $5 million and, or better yet, let's use a lotto example. Someone wins $50 million on lotto and they want to, after they pay taxes, let's say they have 35 million left. And so now they want to live on, I don't know, 10 million bucks, right? And so there's $25 million that they want to, give to a charitable lead trust, and those assets are managed and is generating income for the charity or charities of their choice. And then perhaps let's say, okay, well, maybe after 25 years or 30 or 40 or 50 years, you specify the term, the assets in that trust revert back to my spouse and I or to our beneficiaries. Not a bad deal. So that money is not lost. It's just you're giving the income that those assets generate, and it goes back to your estate in the future. Donor advised funds. This is probably one of the easiest types of giving vehicles that are out there. Donor advised funds. It's an alternative to a private foundation, which is a lot more complex and complicated, and there's costs, but easier to create and manage and requires less money. Donor advised funds invests your donation and makes grants to charities. You can offer advice, but donor advised funds is not required to follow your suggestions. So you do lose a lot of control there. And grants may be made in your name or anonymously, and there's an immediate income tax deduction. So here's what it looks like. You gift to the donor advised fund. You may offer advice, but they don't have to take your advice. And the donor advised fund make grants to the charities of your choice. It's pretty simple. A lot of mutual fund companies, for example, Fidelity Funds has donor advised funds. The community foundations throughout the country, the community foundation and the community foundations in many cities offer donor advised funds. I used to be on the board of the Prince George's County Community Foundation for about, 4 or 5 years. And there was a donor advised fund that they offered as well to support local nonprofits in the community. So they're really that's really a neat way for anyone who wants to give but not go through the process of having to set up a foundation. You can gift smaller amounts of money to a donor advised fund, and it's pretty efficient. So asset protection. Your wealth may be vulnerable to future creditors. That's why we need asset protection. That's why trusts are important. State and federal law may provide a degree of protection, and then adequate insurance protection will provide some sufficient protection as well if you're sufficiently insured. And then advanced strategies includes forming a business entity to hold business assets and transfer personal assets to protective trusts. So that's one of the reasons why people do estate planning and advanced estate planning, because they want to protect their assets and they want privacy. Now, asset protection or business entity, the business owner creates business entity and transfers business property to the entity. The business entity owns a business property. It's a little more complex. So here's the business owner. Owner creates the entity, transfers the asset or property there, and then here are the business assets, and the personal assets as well transfers back. So you have the separate legal entity that owns the business. The business entity is responsible for all the business debts, and the personal assets are not at risk for acts of the business. So, for example, I think the most basic example is like a limited liability partnership, for example. If I have an LLC and the business does something illegal to get sued, my personal assets are protected. The assets of the business are not protected. Basic example of a limited liability corporation. And so if I don't have an LLC and I'm operating as a business and I've got personal assets that that I'm managing as well and get sued, then creditors or those who are suing can come after my personal assets, my home, etc. So having a limited liability corporation, or in our case, we are a corporation, we have that protection, and the business has assets, we have assets, and the two are not commingled. So one of the reasons why people establish business entities, and the proper ones, is to protect against lawsuits and from creditors, from reaching into your, as it says here, the personal assets of the business owner, like their home, their car, their lake house, etc. Asset protection, self-settled domestic trusts. So you can name yourself as primary or even sole beneficiary of self-settled domestic trusts, and the trustee has discretion to distribute or not distribute the trust property. The creditors can only reach property you have legal right to receive. Creditors are unable to reach property while in the trust, and creditors can reach property once it is distributed to you. So you establish a trust, you're the trustee, that's you, and here's your creditors. They're pretty much pounding sand and kicking rocks. They can't get your assets until those assets are distributed to you. As long as it's here, you're good to go. Offshore foreign trusts. Got to be careful with the offshore stuff. There are scams galore. I hear about them, read about them, and goodness, just watch American Greed, after CNBC on a Thursday evening. You'll kind of see for yourself, or a Monday evening, whenever it comes on. You got to be careful about some of these offshore so-called, trusts and ways to protect your assets and wealth transfer strategies. Be very careful. Work with the most reputable of professional advisors when setting these types of things up, if it is even warranted or suitable for you to do so. Highly recommend you establish something like this through your brokerage firm, your investment firm, because they may have the entity already in place and have done all the heavy lifting from a legal and tax perspective to administer these types of credit protection and asset protection vehicles for their clients. So don't just respond to ads in the paper or magazines, or you hear on the radio or TV and all that stuff. No. Get your true team of professionals and be protected. So U.S. courts have no jurisdiction over foreign trusts. Creditors must commence suits in courts of Creditors must commence suits in courts of foreign jurisdiction, and creditors must engage an attorney in a foreign jurisdiction and may have to pay fees and bond up front. Obstacles may deter creditors from pursuing action. Here's your foreign offshore trust, your offshore and trustee, and you guys have this sort of relationship here. Your creditors have to go through a foreign court. They've got to then, from there, access somehow your offshore trustee to you. and get access to the trust. Don't just think you can set one of these things up and avoid any kind of liability, okay? Because you don't know how relentless some creditors will be and how deep their pockets really are. And some of these creditors can put up a really good fight. So you just want to be careful and think about, why you might even need something like this. We're talking about people who have a substantial net worth and they have a clear reason for setting up some sort of offshore entity or trust. In conclusion, is estate planning a concern for you? It's a concern for everyone. You may be the grantor establishing a will or a trust or an advanced estate planning strategy. You may be the beneficiary who's going to be receiving. Maybe you have parents and grandparents who have not yet done the proper estate planning, and you're concerned about the efficient distribution and disposition of their assets bequeathed to you, hopefully. And you want to make certain that those assets are transferred with in the most tax efficient manner as possible, and of course avoiding probate at all costs if possible. So do you plan to give or leave property to your grandchildren? If so, estate planning is also for you. Do you plan to give or leave significant property to a charity? Some estate planning is appropriate. Do you have an interest in a business or a farm? And is asset protection a concern for you? Again, these are some of the questions that you have to consider and will have to answer in order to determine whether or not and to what level you need estate planning. At WealthCare Financial Group, we are big on education. We have a pretty, goodness gracious, 25 years of buying books. So we have a pretty extensive library. Don't know if you can see this or not. Hopefully you can see this, but this is a book entitled Plan Your Estate to Protect Your Estate. Okay? Plan Your Estate by Nolo, 6th edition. A little dated here, but I purchased this book years ago just to give me some insight on estate planning and various laws. There's enough data out there where you can answer a lot of these questions on your own or with the assistance of a financial advisor or a trust attorney or a CPA, so that you can put yourself on the path to protecting your estate so that it does not, so that you can prevent the state or the IRS or the federal government from determining what happens to your estate. You want to make that decision yourself, okay? So I'm very grateful that you've joined and that you've sat in on this webinar. Thank you so much. My name is Martin A. Smith. I am the president of WealthCare Financial Group. Please contact us. We do provide complimentary financial plans, a complimentary portfolio review with a comparative investment analysis. Our financial planning is pretty complex and it's complimentary, so you'll save about $2,000 in doing so. Give us a call if you have any questions. If you want to receive an objective second opinion regarding your estate or financial planning affairs or the management and performance of your portfolio. I can be reached at 770-683-3608, and my email address is right here, msmith@wcfingroup.com. Thank you again. Have a blessed day, and I look forward to being of assistance to you.